Hi, my name is Nandini Gupta. I'm an associate professor of finance at the Kelley School of Business in Indiana University in the United States. Today, I am going to talk about the importance of having an efficient bankruptcy system. An efficient bankruptcy system is important for the functioning of credit markets. If the bankruptcy system is not efficient, then capital gets tied up in unproductive uses. And this in turn can raise the cost of capital and make it difficult for firms to borrow, which will slow down investments and potentially, therefore, slow down economic growth. A World Bank study found that the efficiency of bankruptcy processes can vary widely across countries. So, for example, in the United States, on average, creditors can recover 80 cents to the dollar for bankrupt firms. And for France, for example, this number is more like 60 cents per dollar. However, bankruptcy systems are far less efficient in emerging markets. For example, in India, on average, creditors recover about 20 cents to the dollar from bankrupt firms. Why does this matter? Again, especially in emerging markets, in order to have economic growth, you need firms to be able to borrow or access credit markets and therefore undertake investments that foster growth. What we do in a paper called Bankruptcy Reform and Credit Constraints is we analyze the effects of a very comprehensive reform that was undertaken by the Indian government in 2016 that tackled the insolvency situation in India. Prior to this reform, credit markets in India had been undergoing some trouble. So, for example, non-performing loans of the banking sector stood at about 14% of total loans. This, in turn, affected credit growth. To give you an example, in 2011, the annual credit growth was about 18%, and it fell by 2016 to about 3%. What this suggests is that banks were afraid to lend money to firms that they then couldn't recover because the bankruptcy system was very, very inefficient. So what was this bankruptcy reform? In 2016, the Indian Parliament passed the Insolvency and Bankruptcy Code. What this did was that it set up a completely new ecosystem for the bankruptcy process. Through this code, there were new bankruptcy courts set up across the country. And in addition, a new regulatory body was created that governed administered the elements of the code. The code also helped set up a new set of insolvency professionals who would basically help creditors recover their assets. What we do in the paper Bankruptcy and Credit Constraints is we look at whether or not firms' borrowing constraints are affected by the passage of this new Bankruptcy Reform Act. What do we find? What we find is that compared to before the passage of this bankruptcy code, after 2016, more credit-constrained firms indeed are able to borrow more from banks. So that suggests that the bankruptcy code led to a strengthening of creditor rights, which in turn made banks more willing to extend loans to firms that were previously not getting loans that they needed. We also find that the extent or the effect of the reform on firms' borrowing constraints varies based on the characteristics of the bank and the lender. In particular, lenders that have a lot of non-performing loans, where previously they were concerned about extending more loans that they could not recover, subsequent to the reform, they were lending more. So firms whose lead lenders had more non-performing loans were able to borrow more after the passage of the Bankruptcy Act. And again, this is consistent with the idea that strengthening creditor rights through an efficient bankruptcy process essentially reduces credit constraints in the economy, making it easier to reallocate money from unproductive uses to more productive uses, which in turn allows firms to borrow. We also find that the efficiency of the bankruptcy process depends on the functioning of the courts. In particular, firms that are located in the jurisdiction of courts that have a lot of cases and a huge backlog of cases, so they're not able to render decisions quickly, those firms are able to borrow less than firms that are located in the jurisdiction of the bankruptcy courts that are more efficient at giving out decisions. So in turn, this suggests that creditor rights and the strength of creditor rights depends on the efficient functioning of these courts. So all in all, the bottom line is that in our paper, and more broadly speaking, the policy implication is that strengthening creditor rights is important for the functioning of credit markets. And in particular, attention should be paid to the efficiency of bankruptcy systems. And in particular for emerging markets, this is a really important concern because most firms tend to be financially constrained. And to foster economic growth, it's important that firms are able to borrow. If banks are unable and creditors more generally are unable to recover their assets, they're not going to be willing to lend to firms. Therefore, having in place an efficient bankruptcy system and putting in place bankruptcy reforms is likely to benefit both creditors as well as borrowers and thereby foster economic growth.